Hi guys, sorry we're about a minute late. We're running through some technical difficulties a little bit getting Nick connected, but we've got his audio. If magically the video pops in, we'll be able to see Nick. But in the meantime, it'll be Steven and I. We want to welcome you guys to another one of our webinars. Just kind of talking through some opportunities, some changes. Obviously, a crazy 2020. And with the forced shutdown and quarantine and volatile markets, so just talking through what can we do as advisors to educate our clients, have them be well informed, act as a guide to make sure that they're making the best next steps that they can take. And today we're going to walk through a couple of things that are timeless. Long-term investing. We're going to go through some Dave Ramsey baby steps. So we're excited to get it kicked off. So welcome everybody, and let's get right to it. First thing I want to say is, let me kind of go through here. This is our legal disclosures that the attorneys say we got to go through all of these. Basically, Nick is not affiliated with Kennedy Financial or LPL. He's a representative from Franklin Templeton. And these are all kind of the legal disclosures that you can read at your convenience. But for today's webinar, I want to start by just going over kind of the goals and what we're going to talk about, give you a couple of updates. But our firm, we believe, and it's our passion that we want to help, you guys as clients redefine your legacy and elevate the importance of money in your lives and why it's important to you, because it's so much more than just a number or how much you have in your portfolio. Money is a tool to help us take our next steps to kind of serve a greater purpose beyond ourselves, and that's our goal. That's what drives us. Like I said, to act as a guide, to be there side by side with you through good, through bad, to help you make smart decisions about your finances. We're very excited and passionate about what we do. And one of the things I'm very excited to announce is our team is growing. In the last month, we've added 2 new team members, some that you may know, some that you may not. Bob Dopke is an advisor that I've known for the last 20 years. He was kind of a mentor as I got started in this industry. With LPL Financial, and we're excited to welcome him and have him join our group. We'll have more details to go on his role and what he's going to help, with us and leading forward. And then Lauren, who's on as a moderator, you won't be able to see her here today, but we'll have more information on her. Lauren was with us years ago, and one of the hardest things I had to go through as an advisor, losing her as an admin when she moved out of state. And, kind of the theme of COVID and this shutdown is we were forced to make changes, and we got really good at remote, coordinating. And, we were shut down, I think, for 10 weeks or so at home, working remotely, doing Zoom calls, and we ran our business and we stayed connected and kind of realized we can do this remotely. So we were excited to bring Lauren on, who is working out of Louisville, Kentucky, as a client's experience director. I think I got that title right. Basically focusing on how can we elevate the level of service, form deeper connections with our clients, really get to know, clients on a deep level. One of our core values is to listen deeply and really get to know who you guys are. And that's how we help get good outcomes. And Lauren's going to be a big part of that. So we're very excited for that. And then 2 main topics of focus for the webinar today. Steven and I are going to dig into one of our favorite topics is the Dave Ramsey baby steps. We have both gone through, these Dave Ramsey principles. I will tell you, nothing we're going to tell you today is groundbreaking, but all of it's very difficult. And the number one theme of what we want to do is just be intentional about our money. And the baby steps are really simple ways to, wherever you're at. We have a diverse group that's on this call today. Some 401k employees of small businesses that we work with, current clients, some prospects, all different ages. And these baby steps are timeless and will help you take your next step wherever you're at. So we want to walk through those, and we're excited to have Nick Horton from Franklin Templeton, who's going to go over, which I think is a great theme in today's craziness, is investing in innovation and going through, because I get a lot of questions on, should I still be investing, or is this going to get ugly, and investing in innovation and growth in real companies and their mindset and kind of their rationale on how they move forward in long-term investing in anything, in any type of market. So Nick's going to walk us through that, and we're excited for that. So with that said, we're going to kind of jump right in to our presentation for today. I'm controlling the slides here. Oh, sorry, I jumped. I'll leave it alone. On the Dave Ramsey baby steps, Steven in our for today is going to walk through steps 1 through 3. I'll go through 4 through 7. So I just want to introduce Steven. Steven works as a financial advisor at Kennedy Financial. I've known Steven for 6 or 7 years. And I'll tell you, of all people that I've ever met, I don't know that there's someone that's more passionate about financial planning, helping people, being there for them as a guide. And, he's going to walk through some of these tough early steps of the baby steps, which are incredibly important to move forward. So Steven, take us away.
Yeah, no, thank you, Brandon. Yeah, I think what you said there is these tough steps of the baby steps. And so out of the 7 baby steps, I am very confident that the first 3 baby steps are the most difficult steps to accomplish. Again, the baby steps, the whole idea behind baby steps is that everything should be simplified, right? We don't need to have a million different moving parts to make progress on our financial plan and our financial life. But just because they're simple doesn't mean they're easy. And so kind of starting out at the base of the baby steps, the very first step. Now, a lot of you that are on this webinar, you're probably already past this step, but really baby step 1 is geared towards those who they may be living completely paycheck to paycheck, drowning in debt. It's really a starting place to start for people. And that's to save $1,000 for a starter baby emergency fund. Now we know that $1,000, it's not going to cover every and any emergency expense that's out there. But what it is, it's there to stop the bleeding so that we don't keep going back into debt when another emergency pops up and another. Throwing it on the credit card is not a good long-term solution. So there's actually been a couple of recent studies that 40% of Americans said that they would struggle to cover an emergency expense of $600 or more. Actually, I think it's $400. Yeah, a $400 expense. 40% of Americans would struggle to cover that. And that's because most people out there in America don't have an emergency fund. There's also another stat that 8 out of 10 households in America are living paycheck to paycheck. And that means if, again, like we've seen over the past 4 or 5 months during this forced shutdown, if people are laid off, if you are facing a job furlough, an emergency fund is the only thing separating you between money and not having money. And so the step 1 is the most critical part of the baby steps because it's there to help you keep from going backwards in your plan. Now, step number 2, once you've had that emergency fund in place, that $1,000 baby starter emergency fund, it's to start paying off all debt from smallest to largest. Now, the reasoning behind this is our biggest wealth building tool that we have is our income. So the money that we earn every single month and every single year. The biggest thing that sucks our monthly income and our biggest wealth building tool is debt payments. So whether that's car payments, student loans, credit cards, you name it, that money is being paid to the bank and it's not being paid to you. And so before we can even start thinking about investing or building our future, we need to knock out that debt as soon and as quick as possible, because again, that's the biggest detriment to our wealth building tool, which is our income, is paying out in debt payments. Now, baby step 2 talks about paying off the debt from smallest to largest. And the whole idea behind there is we want to build momentum. Yes, a lot of people will say, well, you should start with the highest interest rate loan first. Mathematically, that would be correct. But if we're doing math, we wouldn't be having all this credit card debt and all these student loans and everything. But what we need at this point is we need a behavior change. We need to have the I've had it moment where we're not going to ever go into debt again. And the only way to do that is by building progress, by paying off those debts from smallest to largest. So you take that first debt and you pay minimum payments plus any extra bit that you can. As soon as debt number one is paid off, you take all the money that you were throwing on to debt number one and move to debt number two. You keep paying that with a vengeance. Once that's paid off, you take all those payments that have been paying on one and two, and it starts to build and pick up more snow as that snowball rolls downhill. And so as you continue to build momentum, eventually you'll get to the largest debt that you have, which for a lot of people, that's probably their car debt or their student loan debt. And at the beginning of the process, that may seem like an impossible thing to even think about paying off. But once you've built up that momentum, you are chunking hundreds and thousands of dollars a month to knocking out debt, and you can easily knock out that largest debt. So the next step after baby step two is step number three, which is we want to continue with that same momentum that we had in baby step two, which is used to paying off that debt. And we want to move it to upping up our emergency fund a little bit more. Obviously, as we said, $1,000, if you've ever had to replace a roof on your house, you know that is not a $1,000 expense. That is thousands and thousands of dollars, if not tens of thousands of dollars to do that. And so that baby starter emergency fund is not going to cover that. And it's not going to cover a lot of other expenses too. So that's why we want to make sure that after we are completely out of debt besides the house, that we bump up that emergency fund to at least 3 to 6 months worth of expenses. Now, for a lot of us, that may look like $5, $10, $15, or $20,000. Really, at the end of the day, it needs to be at least 3 to 6 months worth of your expenses. But also at the end of the day, it needs to be a number that you can help you feel safe and help you sleep at night. Because if you truly feel comfortable with $20,000 and 3 months worth of expenses is 15, go with the 20, because that's going to help you sleep at night and it's going to help have that peace of mind, which really at the end of the day, that is what the baby steps are all about, is helping bring financial peace and financial peace of mind to your life. So that's really the basis for everything else that Dave talks about in the baby steps. I'm going to turn it over to Brandon, because while baby steps 1 through 3, they are simple, they're not easy, but they're very straightforward. Step 1, you do one thing at a time. Step 1, 2, and 3. Baby steps 4, 5, and 6, and then 7, a lot of those happen at the same time. So Brandon's going to walk us through how you balance between those things and what those steps actually are.
All right. Thanks, Steven. Yeah, I mean, just to follow up, and I gave him the hard part. That 1 through 3 are the least fun, probably the hardest to do, to change your mindset, change your behavior. Once you get through those, though, and I've gone through this personally. I when in debt, when I first found Dave Ramsey, I took a Audi S4 twin turbo, a car I loved, drove it in and drove home in a used minivan without a car payment. And that was my real moment of, all right, I'm embracing these concepts, these work. And I'll tell you, in practice now, this is 12 years later, we work with hundreds of families. Those that have gone through and don't have debt payments and had a big emergency fund, there wasn't near the stress, during this shutdown or during this concern of, am I going to have a job through this, or am I going to have a major health scare? Those that didn't have a lot of outgoing payments, and those that had emergency funds, and we had a lot of clients who were furloughed or who lost jobs. If you have a plan behind your actions, going through those tough months are a whole lot easier when you've done some of those early steps. So I really encourage you not to try to do it all. Like Steven said, take those next steps one at a time. And then once we get to this point 4 through 6, now we have lots of cash flow. We have reserves in the bank. We can start to set some goals and some priorities. And this is what we help, with clients, help them prioritize. But basically, we're going to go on 4 through 6. We're going to save for the long term. We're going to build up a college fund if we have kids, and we're going to pay off our mortgage. And we're going to prioritize those depending on your situation and where you're at, and what some of your short and midterm goals might be. But number 4 is where you want to get started and investing at least 15% of your income into long-term investments. We say towards retirement because that's a long-term focus. Probably the single biggest asset that we're going to have to build up is our retirement nest egg. But really, this is any money that is not earmarked for a major purchase coming up in the next couple of years, for the emergency fund that we have to have, should start going into longer term investments. Nick's going to get into why we do that and how the mechanics of that work, of instead of putting our money in the bank versus putting it in long term investments, why we might do that. But that's where we want to get. As a general rule of thumb, investing, we could have a whole webinar on different vehicles that you can use. For the most part, the general rule of thumb, if you have an employer retirement plan and they provide any sort of match, start there once you're on step 4. So if you get a 3% match and you have to put 4% of your income, at least do 4% of your income and get the free match. Then start the conversation of, do we want to diversify outside of our employer plan? Maybe have more investment options available, potentially do a Roth IRA for some tax-free income. Or if we're not building all of our money into retirement assets, IRAs, 401ks, we might fund an after-tax investment account that's a little bit more flexible and available. If you're 35 years old and all your money's going into your 401k, you're going to have a boatload of money when you're 55. But really, these IRAs and 401ks, we can't touch till 59 and a half. And I have a lot of people who are exactly this. You've heard the expression house poor, where all your money goes into your home and you don't feel like you have any wealth. You can also be kind of in your early to mid 50s retirement poor, where you might have $2 million in your retirement accounts and you're 50, but you don't have the money that you can access that's not really for retirement. So an after-tax account's another really good place that you can put those in. I get asked a lot, is it 15% on the gross or is it on the net? It's kind of like a tithing conversation, right? Just do one of the, at least start there, right? If it's on the net, that's fine. If it's on the gross, that's even better. And that's a general guideline. If you can save more, save more. It gives you more flexibility, more options.
Like you said, the biggest thing is, the whole idea is we want to do a significant amount of our income going to long-term investments. And that's the biggest thing, is a significant portion. So 15% is just a rule of thumb to start from.
Yeah. No, in practice, we have clients who save a whole lot more. Sometimes we have to encourage them, hey, are you spending money? You got to enjoy this along the way. But they understand compound interest. And the more you get in, the earlier you get it, the more you're going to have later. And that's why we want to get there. College is a tough one. So that's step 5 is college. If you have kids and if you want to provide for their education, right? So they're not starting their life in baby step 2 with a ton of debt, with a $1,000 student loan payment that's going to take them 20 years to pay off. We want to set our kids up right better than maybe we were. So if you can, we want to build up a college savings account. Now, I will tell clients, all right, if we have to prioritize, retirement's non-negotiable. We can't sacrifice what retirement's going to look like because, when we hit a certain age, we may not be able to work any longer, and there's no going back and doing do-overs. For college, we have a short period of time. So, if your kids are 10 or 12, you might not be able to fully fund college, and that's okay. You might want to put some there. Retirement's got to be the focus. If you have enough cash flow for both, this is where we take advantage of investments like 529s, education savings accounts. Even that after-tax investment account that I talked about is liquid and available, doesn't have to be used for college, but start putting money in that's accessible for that period of time when they're in school. And you get some tax benefits if you use the 529s and education savings accounts. So that would be your 4 and 5 if you have enough cash flow. And then number 6 is paying off your house early. I think Dave Ramsey, and we've been partnered with them for a little over 7 years. I've been, integrated in their, processes and baby steps and everything that they do with Ramsey Solutions for over a decade. They're kind of vague on paying off early. For most people, it's at least before retirement. What is most likely your single largest outflow of money And some people, we have clients who have big mortgage payments, and it's okay, right? They have bigger shovel, a lot of money coming in and a lot of money going out for a house. That's their single largest expense. So if you have a $3,000 mortgage, you refinance, maybe you're at a 10-year mortgage and you're aggressively paying it off. As soon as that mortgage is gone, you feel like you got a raise, and you did. You now have $36,000 more annually of cash flow. For most people that are planning for retirement, that's a tough one to carry into retirement because it's a larger expense. And if we're living on a fixed income of some kind, having what is our single largest outflow paid off, is a great place to be. If anybody has questions along the way, I didn't include that, but you can go ahead and submit them in the chat. I know we got a couple that we had prior, but go ahead and submit questions if you have any of those. One that I'll proactively, I know we've been asked this, is should I pay off my mortgage now or should I save more in my investments? There's no right answer. It's more of an art than an exact science of the answer. But for the most part, with interest rates as low as they are, I've seen people refinancing at 2.75%, under 3%. As long as we're on a plan to pay it off and the interest rates being so low, I would be okay keeping, if you're on a track to avoid. Now, don't go and refinance because interest rates are low to a new 30-year mortgage and reset and add 10 years to your mortgage. Those are bad decisions. But overall, if you had to make the choice and it was one or the other, getting more into long-term investments in most cases is you're going to outperform what that interest rate might be. But the big thing is we want to eliminate what that payment is. And if we do that, we feel like we got a raise. And that's where we want to get. So like I said, for most of the clients that Kennedy Financial is working with, they are actively on steps 4 through 6. A big part of our process is we use this listen, plan, and review. We listen to you. What's your priority? Because I have a lot of clients over the years who have just said, I don't want this mortgage, right? I just want it to be gone. And that's important to them. And that resonated because we ask lots of questions and we kind of dig into what drives you and what's important to you about money. If paying off your mortgage and having that gone is more important just from a mental mindset, then we'll attack that and we'll go after that. And then we'll start to save, more once that payment's gone. I will tell you in doing this, almost 20 years, I've never had a client regret paying off their mortgage and say, oh, I wish I wouldn't have paid that off so early and I wish I would have saved more. That is a true freedom, right? When you have now gone through and you have no outstanding debt, you don't owe anyone a dollar. That's freedom, right? That is financial freedom, and that's where you want to get.
Like you said, you can always go back and you can always get a mortgage if you want to. If it really feels that bad and you really are missing that mortgage payment, you can always go. You can always go get that mortgage again.
Yeah, there's nothing that says you can't. But freeing up the cash flow, having that burden off of your shoulders, is a huge win and a huge step. And then this is, like I said when we started, money is bigger than all of this, right? So how much you have in your IRA or your education account or how fast you paid off your mortgage, those are just numbers. Why we do all of this is to build real wealth, true wealth, so that we can do the things that we want to do in life, right? So that wealth can provide helping somebody and making an impact in the world. You can give to your church or charities that are important to you more so than you ever could if you're burdened by outgoing payments in debt. One of my favorite things that Dave Ramsey says is, two things. I'll share them both. One is if you have no mortgage and no debt and you've got a couple $1 million in the bank, what can you do? And his answer is anything you want. And that's freedom, right? There's not a decision on, can I go on this big vacation? We've had the pleasure to plan with a lot of our clients on going on once in a lifetime trips and vacations that they never thought they could do. And that's a lot of fun to do that. We've also had with a lot of clients and even young clients, right? This isn't all legacy type stuff or end of your lifetime type stuff that have run some numbers and talked through, hey, we want to have, and we have one client in particular who has a generosity fund. They literally add money every month, and we backed into how can we build this account up to $1 million. That's fun. That's a ton of incentive to do all of these tough steps to have money become more than just an account number. This gets us to the point where we can be generous and we can give and we can impact this world and really change our family tree and change this world for positive. Because that's the goal of all of this, right? Money is beyond us. We're not leaving with any of this money. We're either passing it on to our kids or making an impact in the world. And that's the goal of what we want to help you do. And you know, working with an advisor, we're able to get into those conversations and to talk through, you know, it's not about how much we can accumulate at the end of your life. It's what kind of legacy can we leave behind us? And those are the great conversations to have. So there you go. There's the 7 steps. I don't know if we have a recap or if you can, if we have them all listed, but it basically moving along, right? Being intentional with our dollars, then getting out of debt. And like Steven said, freeing up our single largest outgoing expenditures to help us have a wealth building tool and fully maximize our income. Having an emergency fund for reserves, and then building up for specific goals like retirement, college, and paying off our mortgage, and getting to that point where we have real financial freedom and independence to do the things that we want to do. That's the journey that we're on. Our role at Kennedy Financial is to be a guide along that journey, and you know, anything we can do to kind of help you walk through wherever you are, we'd be happy to talk through that with you. So now for the featured presentation, and it doesn't look like we got Nick's video, but we've got him on the line. We're going to navigate through some of his slides. Nick is a vice president and senior advisor consultant with Franklin Templeton, and one of our you know, the things that we work on and strive for as independent financial advisors is to partner with great resources that are not tied to how much money we make, but just to kind of search throughout the world and look at who are the best partners that we want to work with. Franklin Templeton's one of those that just has a long track record. Hopefully Nick can give us a little bit of an overview and feeling for Franklin and who they are. I've known Nick for several years. He's a local here in Michigan representing Franklin. And Nick's going to talk about investing in innovation, because I'll tell you, if I've had one conversation more than any other, it is, should I invest now? Is now still a good time to invest? It seems like this market got ahead of itself and it's, you know, it recovered faster than I thought. There is never a good feeling or time to invest. And Nick's going to talk through what we are. If we just break down, you know, we get caught up sometimes in the S&P 500 and the Dow and what's going on. If we just strip all of that out and look at, we are investing in real companies, and the companies that we want to invest in are innovative and disrupting. And Nick's going to get into a little bit more about their process and how we identify some of those things. So I'm going to turn it over to Nick. And Nick, thanks for being here with us. And we look forward to hearing, we're not going to be able to see you today, but hearing some of your insights. Do we got Nick?
Nick, you there?
Yes, I am. Yes, I'm here. Thank you very much, Brandon. I really appreciate it. Steven, can you confirm with me that I'm good to go?
You are here, and we're ready to go.
Excellent, excellent. I'm really bummed out that we're not going to be able to video chat, because I wanted to have a real lively debate about whose haircut is best, Brandon's or mine, because I think we both see the same barber every couple of days, right, Brandon?
We've got that look. I haven't seen Nick since quarantine. He might have a beard now. Since I don't know.
No, I was about to say the only thing that separates us is the facial hair, my friend. But I will say we're both pretty good-looking guys for what the hand we were dealt. I'll say that.
There you go.
But thank you so much for having me here today. Thank you all for taking some time out of your day to come hear not only what Brandon and what Steven has to say, but of course what we have to say here at Franklin Templeton. You know, first and foremost, I hope I find all of you, you know, still very safe and healthy at home. I know this has been very, very trying times. But what I will tell you is listening to what Steven and Brandon presented in terms of those baby steps from Dave Ramsey, I think, you know, if you could follow those steps, you have 99% of your financial life taken care of. And in fact, I really like the fact that, when it comes down to getting that money invested, when it comes down to choosing what those investments are, we think that's a relatively small decision you have to make as an investor, right? Because most of the major decisions are what Steven and Brandon went over in terms of paying down debt, making sure that you're making smart financial decisions, understanding that all of these investments that we're going to talk about are for the long term. All of those things are going to serve you very, very well, not just during volatile markets like what we're with today, but throughout your financial lifetime. So I think first and foremost, you're in wonderful hands with Kennedy Financial, considering that is the sort of direction that they head when they interact with their clients. So thank you so much. That was a wonderful, wonderful presentation there, Brandon and Steven. But yeah, so, once we get through all those steps, eventually we come to the question in terms of what should we invest in, how should we invest, and so today what I wanted to do is just give you a little bit of an insight on who we are at Franklin Templeton, but most importantly, just talk to you a little bit about what we're thinking about the markets, some opportunities that we think are investable not just today but in the future as well. You may have heard of Franklin Templeton before. We're actually a very large money manager. We've been in existence since 1948, which is really interesting. We love to talk about the fact that we've seen a lot of different market cycles in our history, going all the way back to some of the incredible things that were happening during the 40s, the 50s, the 60s, and 70s, all the way up until where we are today. So we really like to say that we have a very long-term perspective of the market, just like what Brandon and Steven said when it comes to looking at your investments from a long-term standpoint. And so we think that we're in a very unique position to kind of show you a little bit about what we're thinking about for the future. Considering that we have a lot of information, a lot of data in terms of what has happened in the past, today what I wanted to do is maybe give you some reasons to be optimistic about the future. So first, I was going to show you a nice visual. Steven, you can kind of confirm with me that it's up there, but we're going to kind of look at how technology has progressed over the past several decades. So can you confirm with me that we're there, Steven?
Yep, we're here.
All right, perfect. Thank you. So, today's technology isn't necessarily tomorrow's. And that's something to really think about, because you can see on this graph that how rapidly and dramatically technology has changed over the past few decades. I always love to point out that, the real groundbreaking technology in the 1970s was photocopies and instant photos. And we can almost agree today that those technologies are almost obsolete from where we stand in 2020. And we can see over the next several decades that we see technologies come and go. From the Walkman in the 1980s. Think about how the Walkman really revolutionized the way that we consume music. But then you can see just by the 1990s, we've gotten to CDs and DVDs. And then, of course, by the 2000s, we're talking about streaming media and all of that good type of stuff today. So you can see that technology is constantly changing. And by thinking that, hey, we're going to invest in the technology of today, that's not necessarily indicating that those technologies are going to be around in the future, right? Because we're currently going through a lot of the obsolete technologies of what kind of got us here, and we're moving into some of the technology that will kind of leave us into the future. So you can see in the final sort of bar here where it says 2010 to present, you can see we're looking at a lot of different technologies that range from cybersecurity, e-sports and e-learning, which has obviously gotten very popular and important now, considering where we are with the coronavirus. But other things like robotics and social media and software as a service, all of these things we think are even jumping off points for where technology could be headed into the future. So the first thing is to remember, when Brandon says that we want to be long-term investors, that means we have to really consider not what is necessarily working today, but what could be working in the future. And of course, that's something that we do at Franklin Templeton basically all of the time, right? So Steven, let's move to the next slide if you can.
Yep.
And so now when we start talking about what are some of the ideas that we're thinking about for the future, here are about 5 of the key themes that we're thinking about in terms of technology looking forward. So what I'll do is we'll go over each one of these in a little bit more detail. Once again, if you have any questions, I think I do have access to the question side of things on the webinar there. But what I'm going to do is I'm just going to kind of show you a little bit about how each one of these these areas of technology exist today and how it might be considered in the future as well, if that works for everybody. So first off, let's talk about global e-commerce. Now, this is something that I think that we've all become pretty familiar with, not over the last just couple of months, but of course over the past couple of years. And of course, we know that we're buying a lot more things online today than we were several years ago, right? I always like to make the joke, remember, Amazon started as a bookseller online. In fact, one of the only things that you could buy on Amazon when it was first launched was books, right? But of course, you know, Amazon has really grown into a giant retailer. You can buy anything from, you know, shaving razors to bathtubs to whatever you might need on Amazon. So we know that the growth of global e-commerce is continuing to expand. But of course, we know that's really been pushed forward by the coronavirus epidemic that we're dealing with right now, right? We know that people, you know, like to buy stuff on Amazon, but now we've seen people are buying groceries online. In fact, now we're seeing companies that will actually deliver automobiles to your house so you can buy a car start to finish online nowadays. So obviously we think that global e-commerce is going to continue to move forward, not just in the day-to-day household items that we're kind of used to ordering off of Amazon, but we think that those items could get bigger and more substantive as time goes on as well. So we think global e-commerce is obviously here to stay and a theme to continue to run with when it comes to investments. The next theme is genomic breakthroughs. This is actually an area that I find to be very, very fascinating. Obviously, we know that we have now mapped the human genome. We actually mapped the human genome in the early 2000s. So we know that we have a very thorough understanding of how the genetic expressions that can drive certain situations within our human experience, right? Whether that's disease, whether that's eye color, whether that's anything else, we all know how those genes sort of dictate that. But if you think about how those genomic breakthroughs are being utilized today, well, first and foremost, we all have to understand that the novel coronavirus, or the virus that we're currently fighting in this global pandemic, has also been analyzed at the genetic level. In fact, a lot of the therapies, a lot of the vaccines that are currently being developed are using the genetic understanding of this virus to determine how we can overcome and defeat this global pandemic. So not only is genomic breakthroughs helping us deal with our current situation by having a thorough understanding of the genetic breakdown of this novel coronavirus, but we think that will continue to help us address longer standing, more detrimental viruses, or not even viruses, sicknesses, you know, like cancer, diabetes, those type of things. So we think the genomic breakthroughs continue to help us push forward with a lot of the healthcare, a lot of the therapies that we will develop in the future as well. Not to mention that agriculture is also something to keep your eye on there as well. We've been very successful developing, you know, new agriculture strains that are drought resistant or are able to tolerate other environmental factors as we try to deal with continuing climate change. So once again, genomic breakthroughs is also something that we think is not only working today, but could be very well positioned for the future as well. The third is intelligent machines. Of course, intelligent machines are something that we are probably pretty familiar with. I don't want you to think about the Terminator when you think about intelligent machines, however. What I do want you to think about is the idea of robotics and how robotics continue to help us in the manufacturing space. But robotics are also now being pushed into additional spaces. We know that obviously you could go into any, you know, auto sort of assembly plant here in the Detroit area, and you will find robots assembling automobiles almost more than you'll find humans nowadays. But what we're also finding is that robotics will also help us overcome this global pandemic as well. We're seeing lots of companies that are now rolling out robots that will help stores identify when shelves are empty and trigger a restock. We're finding that there's robots now that are able to go in and inspect, you know, dangerous situations like radioactive leaks or volcanoes or anything along those lines. So we think robotics is going to be a very important consideration, not just today, but of course in the future. One last thing that I'll point out in the intelligent machines area is this idea of Internet of Things. This may or may not be a theme or a term that you've heard, but you will in the future. And the Internet of Things is simply the advancement of connected devices. So we know that a lot of people now use Amazon speakers, Alexa, right? Because Alexa can not only help you order things on Amazon, but now we can get Alexa can control your lights. They can control your television set. They can control your washer machine. And in fact, we think that this is going to be a major growth opportunity in the future because unfortunately, one of the biggest areas we've seen impacted by the coronavirus breakout was in nursing homes. And we think now there's going to be a lot of hesitation for people to move into those style of preventative or ongoing care facilities. And we actually think that the connected devices within people's homes may allow them to live in their home a little bit longer. If someone has some mobility challenges, but yet wants to turn on the light, maybe a connected device, a voice command will allow them to control their lights and allow them to stay at home a little bit longer. So we do think that intelligent machines move beyond just robotics and into these sort of connected devices that obviously are making our day-to-day lives easier, but could have very, very powerful implications on future generations in terms of how long they live in their homes and things along those lines. Getting towards the end here, if we look at new finance, this is something that we should be pretty familiar with as well. New finance obviously includes e-payments. If you think about it, if we're buying a lot of more stuff online, then of course, we're paying for a lot more things online. That's not just with companies like PayPal or Visa or MasterCard, but now you're seeing that we have interpersonal monetary transfers through apps like Venmo. In fact, whenever we have a babysitter come over to watch our kids nowadays, I don't pay our babysitter in cash anymore. I just Venmo her, and then she's off to go back to her schoolwork or what have you. So we think that e-payments are going to go well beyond just buying and selling things, but it's going to allow us to exchange currency or to exchange value as individuals in more simplistic terms than carrying around a big wallet full of cash. So the other thing that I'd like to point out here in the new finance category is the idea of distributed lending as well. This is something where maybe you're familiar with those websites like SoFi or Lending Club. Those now allow peer-to-peer lending to exist. So if I had a lot of money and I was looking to invest that at higher interest rates than what I was getting in the bank, and let's say Brandon needed a loan, well, there's a chance that we could link up on SoFi or Lending Club and I could lend that money directly to Brandon, and we've sort of cut out the middleman of the bank. And so we think, obviously, as we're going to deal with some continued economic challenges in the future, we think that distributed lending and allowing more peer-to-peer lending might make some of those economic consequences a little bit easier to bear for the individual. And then last, of course, but not least, we have exponential data. Of course, we know that we have access to a lot more information today than we did several years ago. In fact, I read an interesting statistic that we have actually generated more data over the past 5 years than we have in the entirety of human history before us, which means we now have more information about our world than we ever have before. And what's interesting is that the way that we're using that data is going to change as we move forward. I'm going to use a funny story here. I think it's something that all of us can relate to, but have you ever talked to a friend about something? Let's say that you're planning on buying something, and then all of a sudden you open up your Facebook page or you open up your Instagram account, and boy howdy, there's an advertisement for exactly what you were just talking about. And a lot of us think that our phones are listening to us. And there is some element of truth to that. But actually what we found is that it's the fact that we have more data and the fact that we know more about a person like you, that advertisers are able to make much more succinct advertisements. And in fact, they're able to time those advertisements out to a time during the year where you might be more likely to buy something like that. So as much as it feels like your phone is listening to you, odds are it's just the fact that we know more about the person or the type of person you are, and therefore the advertising can be a little bit more succinct to you there. So once again, exponential data is something that obviously we continue to work with. But the other thing that I love to point out in this category is the idea of augmented and virtual reality as well. Those things continue to be very, very advantageous. Not only on the entertainment front, of course, every one of us who's been locked in the house for the past couple of months have had to find new ways to entertain ourselves, including ideas like virtual reality and things along those lines. But augmented and virtual reality will also help in that genomic breakthrough in healthcare sort of arena as well. What's really interesting is that we are finding that some of these biotech companies that are trying to develop therapies for COVID-19 are actually using artificial intelligence to speed up the testing process of their drug. And so what we're finding is that artificial intelligence, virtual reality, all of those things continue to be major players in households going forward. So hopefully we took just a few minutes to go over some of the key themes that we've identified at Franklin Templeton as themes that we think not only look pretty interesting today, but could very well carry us through into the long term. These are the type of ideas that we're starting to pay closer attention to when it comes to what we're investing in. But the other thing I'd really like to point out is that sometimes when things are new, they are often misclassified. And there's a graphic on here. Stephen, can you just confirm that that's what we're looking at right now?
Yep, we're right there.
Excellent. So one thing that we really love is that when new technologies come out, they're almost always misclassified. And what we mean by misclassified is that a lot of times as human beings, we try to put ideas into boxes, right? But of course, we know ideas can take on minds of their own, and sometimes they don't fit into the boxes that we've tried to put them in. And so what you can see is that there's a lot of times where some of these technologies we believe are misclassified, and that does lead us to opportunities to buy low in some of these arenas. The one that I like to show off is the idea at the top, where if you think about it, most robotics and 3D printing companies are currently listed in the information and technology sector when it comes to investments. However, we at Franklin Templeton, we prefer to view robotics companies through the industrial lens. Because even though robotics companies are very technological and have a lot of technology going through them, the end sort of market or the end user of robotics tends mostly to be industrial companies, right? Like auto manufacturers or other types of manufacturing. So it's when these massive misclassifications really give us rare opportunities to invest in ideas that are not necessarily being recognized by the broader market, because they may be placed into a category that doesn't necessarily reflect their end business usage. And so this is where we can say, hey, we've got these great themes, but truly where the rubber meets the road, and oftentimes where Brandon and Stephen and I are having conversations on a regular basis, is areas that we believe are misclassified and therefore mispriced, and could very well be a very opportunistic investment given where we may stand. So once again, this is something where we say, hey, look, as a serious long-term investment manager, hoping to continue to be the primary business partner of the serious long-term investor, just like what Stephen and Brandon outlined earlier today, we want to make sure that you understand that we are definitely thinking about the long term when it comes to opportunities and themes. But also, we also want to make sure that when we go to pursue these opportunities, we're not paying too much for them, right? And of course, we think that this misclassification type of idea really allows us to do just that, which is find underutilized technologies, underutilized ideas, but if they may or may not be misclassified, allows us a better entry point than if the whole market knew about them, I guess. So I guess that's what I would tell you is that the reason why you pay, financial advisors like Brandon to help you come up with a financial plan and establish your goals was very well thought out in terms of those Dave Ramsey's baby steps that Brandon and Stephen outlined earlier. But I would also tell you when it comes to the execution of that investment that you can trust us at Franklin Templeton, because we of course are thinking about the future, but making sure that we're not paying too much for it today. So with that being said, that'll be kind of the end of my prepared comments. Of course, I would be happy to answer any additional questions that have come up from the group, or Stephen or Brandon, if you have any questions, I'd be happy to address those with you as well.
Thanks, Nick. No, that was really informative, and I think just maybe a different way to think through things. We're not getting caught up in what the market is worth today, and backing up and saying, all right, what we're buying for our long-term wealth building, assets in our retirement accounts and our investment accounts are real companies. and we're not just gonna, this is where we're not gonna just necessarily just buy the index, because the index is going to include things like airlines and cruise companies and maybe some outdated firms that are not moving forward. And disruptions like this, just like we had, in every decade that you go through, cause innovation and cause disruption. And having partners like Franklin Templeton and other managers that are forward looking and are building wealth, not for what happens over the next year or two, but for the long term. That's a big difference in what your results look like over time. And that's, just a different lens to kind of look through, when you're, obviously most of the clients that we work with, we use this a lot: time, knowledge, and desire. Don't have all three of those, right? Even if you have the time, that you're taking away to manage your own money and to do your own financial planning, is that what you want to spend your time on? And do you have the desire? But where I think we can add the most value is that knowledge piece, and using great resources, great managers that have a process for identifying, good investments. And that's the whole package of putting it all together, through a planner, through great managers, and helping you get there. So Nick, thanks for sharing some of the insights on kind of what's out there, right now. And if we did this presentation a couple of years from now, I'm sure that chart would look completely different, and we'd have to kind of reset what is new, what is innovative, and what was innovative today is not anymore. So thanks so much for that. I'm going to run through a couple of questions, and then we can kind of go from there. But one was a question of if you're putting funds in a Roth, or how do you weigh putting extra funds in a Roth 401k or an outside investment account, assuming Roth IRAs are already maxed out, currently investing in the company match. So this is one that there's not a blanket right answer, but I will tell you in practice, having a pool of money that is available, that doesn't get all of the retirement benefit, or the tax benefits of retirement accounts, is powerful for a lot of reasons. It could be a career change when you're 50 years old, and you may have adequate retirement funds that if you just left those alone, you're going to be all right at 60. You need to access some of that money. We're 401k, and even if they're Roths, really 59.5 is the magic number. Now there's some access to Roths that you can take. So the trade-off is you pay taxes on some of the money now, but you have complete flexibility. And this could be for launching a business, before 59.5. This could be for, that kind of gap between when you go to take money out at age 60 or later. It could also be for fun stuff, right? A second property that you want to buy, a vacation home. If you're trying to enjoy the summers, maybe it's a lake, property in Michigan. If you're trying to get out of here in the winter, it's somewhere down south that you own. Those assets really are hard to purchase with a retirement account because they're just not accessible. And even if they are, you might pay a boatload in taxes in a big lump sum. So a pool of money that's liquid and available gives a lot of planning opportunities. Kind of hedge your bets, right? Some in Roth, some in pre-tax for the tax purposes, some in an after-tax account that's flexible. And that's usually how we navigate those sorts of things. Stephen, did you have any other questions or anything that you wanted?
Yeah, it looks like we've got another question of just for the emergency fund. Once you've built up that 3 to 6 months worth of an emergency fund, where do you actually put that money? And it's a good question. I would say that with the emergency fund, the goal of the emergency fund is not to make you money. An emergency fund actually costs you money, right? It's money that you're not investing. It's money that you're not putting into the stock market. Your emergency fund is really like an insurance policy where your car insurance, you pay a premium every single month or every 6 months that is there to help protect an asset of yours. In this case, for car insurance, it's your car. Your emergency fund is there to protect your assets, like your 401k. There's been a lot of talk recently with the CARES Act that was passed back in March that you can take money out of your 401k without penalty now. that is still, if you take money out of there, that's costing your future self, because that's money that's not invested, not taking advantage of compound interest. So your emergency fund is not there to make you money. It's there to protect you in the case of emergency. So that being said, where should you put it? You can put it in just a checking account, savings account. If you want to earn more than what the big banks are paying, which is 0.00 whatever percent they're paying these days, you can look at something like, they call it a high yield savings account. A lot of online banks and credit unions typically will offer these. You might be able to earn between 1% and 2% on your money in these types of accounts. There's a couple of options. I know Ally Bank Online has that option. Capital One is out there. If you just do a Google search for high yield savings accounts, you can find a couple of different options that you might be able to use.
So to follow up on that too, because I know we get some questions from time to time on, well, I'm comfortable with risk, right? I'm okay if my accounts go up and down. I understand that. Can I invest my emergency fund, or should I invest my emergency fund? And the answer is no, because guess what happens, and when you typically access, now emergency, can be things like a roof or a furnace, things like that are unexpected. But typically, especially if you're tapping into, now you're on the larger end of needing 6 months of a reserve, it's for a job loss, right? Or something unexpected that you don't have any money coming in. And when do those things tend to happen? They tend to happen in environments like this. We're in a pandemic and a recession, and when most people needed access to money, it was in end of March, sometime through April. And guess what happened to the stock market? It was down 37%. That's, you lose money one of two ways by being a long-term investor or changing your course as a long-term investor. Number one is emotion, right? You get freaked out and you sell because you don't like how your statement looks, or you just think it's going to be worse, right? We talked about this time it's different. One of the four most dangerous words you can say in investing. But that tends to be the time that you would need to access your emergency fund. So if it's invested, what are you doing? The second way you lose money is when you need the money. So if that money's invested and goes down in value, and then you need to go cash it out, you actually lost money, and it defeated the purpose of that. So, that's a reason that you probably don't ever want to invest your emergency fund. You need to just be comfortable that it's safe and secure, and it's all there when you need it, and you tend to need it in times that are ugly. Another question that came through. I heard this incorrectly. Did Brandon say 401k and Roth IRAs are not accessible to age 59 and a half? So there's some caveats to that, from a planning perspective. So Roth IRAs, one of the benefits, now typically for a long retirement or early retirement, you're going to have some other outside money that you need access to. So there's a couple of things of how to access your money prior. Any contributions to a Roth IRA, any dollars that you actually made as a contribution can be used without any tax or penalty. So that's one way you can access some of those money before 59 and a half. And then there's also something, and I'm going to get way into it, but a 72T allows you have to follow certain rules within the IRS that allows you to take money from a 401k prior to 59 and a half. I'm not going to give advice necessarily on that because it's a case-by-case basis, but there are mechanisms to do that, but not large lump sums, right? You couldn't buy a property. You couldn't take money out, in a lump sum. And even if you did, you're going to get hit pretty hard with taxes. So there are tools and things available to you, but planning, depending on your situation, having some buckets in all of those areas give you a lot of flexibility, to make some good decisions. I'm trying to think if there was anything else. I think we covered most of the questions that have come in. Nick, I'm putting you on the spot if you're still on there. Any other closing thoughts or anything else? Just from Franklin Templeton on navigating down markets. I know that's a timely discussion on how you do any of that. Any kind of final thoughts on your front?
Yeah, of course. What I will tell you is that I've worked for Franklin Templeton for 14 years. I've been blessed to work with wonderful financial advisors like Brandon and Steven, and I will tell you this: the one word of advice I could give to you is that the plan is worth like 99% of your effort and 99% of your headspace, and the investment management is just a very, very small piece of it. So what I love about this webinar is that all these questions were about the plan. You know, which vehicle should I use? How much should I contribute? Because in the end, what I want all of you to know is that the investment management part is such a small part of your financial, your path to financial independence. That you should really pay less attention to what the market's doing, less attention to what your portfolio is doing, and more attention to the plan and some of the course corrections that you're going to work with your advisor going forward. So for everyone who wants to know what the market's going to do this year, what the market's going to do next year, my one word of advice is go back to your financial plan and just make sure you have enough emergency funds together, enough of a long-term outlook. All those things that Brandon and Steven talked about today are worth 10, 20, 30, 40 times more than a really, really good investment portfolio. And so I will leave you with that you are in very good hands with Steven and Brandon, because they are focused on your financial plan, they're focused on your financial independence, and the capital market stuff that we get to deal with, is still a very, very small part of the relationship, and that is how it should be. Because all of you on the webinar, all of you on the call here today are individuals. Your plans need to be reflected as such. And once again, the investment management part of things is just a drop in the bucket when it comes to your journey towards financial independence. And once again, I'll say it again, I think you're in wonderful hands with Kennedy Financial over there, specifically Brandon and Steven. So thank you very much for having me here. And once again, I hope everyone stays very safe and healthy during these uncertain times.
Thanks, Nick. Appreciate the kind words. And again, just thanks for your insights today. You know, one of the things I'll kind of close with, and this is just maybe sums up what a financial plan is and what we do as a guide. And we draw this out where we have these two intersecting circles, and it's what matters and what we can control. And what matters is not what your money does, right? It's what your money can become and the goals that you can achieve and the empowerment and the purpose behind the money that you have to get your kids through school, to retire comfortably, to make a difference in this world. And then what we can control, how much we put away and where we put it and our behavior on that. And that's what we do as a guide to help you make smart decisions. It's to help you focus and prioritize what matters and to put a plan together with the elements that we can control. And those that do that have much better outcomes than those that are just kind of winging it. So anything we can do to be a part of that process, we're happy to. One of our core values is to have a servant heart and to be there. And that's really what we are. We're there and available, to help you navigate these crazy times. So, on behalf of Steven and Nick and all of our team at Kennedy Financial, I thank you for attending. And to reiterate, Nick, stay safe and healthy and enjoy the rest of the summer. Thanks so much.
Thanks, everyone.
And take care.
Thanks, Nick.